get across the current market outlook amid lots of volatility, of course, what the implications are, particularly on tactical asset allocations. Grant Mundell is the investment specialist from Equity Trustees. He joins us now. Grant, welcome to Ausbiz. Good to catch up with you.
Thank you, Andrew.
Don't know, do you have any particular interest in what we've seen with Rio at the moment? I don't know whether you guys are across that, but do you have a particular view on what Rio have done?
Look, Rio's a stock we hold in the portfolio. It's we think the deal looks like a good one. They've look like they've acquired those assets below replacement value. They're being counter-cyclical in what they're doing, and they're acquiring some good quality assets. So they're increasing their size in a part of the market that they think structurally is going to be very, very strong. Obviously, they're taking a very long-term view around this, but M&A is an interesting one now to perhaps give a bit more of a floor around that lithium price as well.
Are you expecting more M&A in that space then as a result?
Look, I think over time there's a chance that will occur. I think if you look at different commodities, those resource companies have done particularly well where the industry structure has been quite consolidated. So given we do think this is a commodity with longer-term strong demand features, we would expect that if you can curtail or consolidate some of that supply, that will be positive for the industry.
Grant, when you take a look at the resources sector locally at the moment, how are you viewing particularly those most recent moves in the wake of those that stimulus that's been announced out of China that's obviously lit a fire under commodities, and we have seen something to a degree of a rotation out of the banks into the resources sector. How do you view what's going on there?
Yeah, look, I think it's a really good point. Obviously, we've seen massive outperformance of the banks relative to the resources, and that's really been on the back of the disappointment of growth out of China, in particular, obviously, the real estate market. So it feels like from a China stimulus perspective, the Politburo tone explicitly changed a week or so ago, given that 5% growth target really at risk. And I think they really made the point they want to stabilise that property market, lift consumer confidence and mitigate some of those deflationary risks that have become more prominent. Obviously, we're going to hear a bit more from the Chinese authorities over the course of the next few weeks to understand the size, the enactment and the implementation of that policy. But from a resources perspective, we're probably broadly neutral at this particular point in time. We think the banks are expensive, and so really the banks have sort of benefited, I think, from the demise or the lack of growth out of China and the implications of flows out of the resources sector. So if we see a bit of an unwind there, a little bit of underweight or short covering in the resources sector, that could be quite positive for resources and commodity markets, but it will come down to a little bit more of the detail that we hear out of the Chinese authorities over the next few weeks.
So Grant, given that, and more broadly what you're seeing in the local market at the moment, have you adjusted your asset allocation?
Yeah, look, we've been slightly underweight equities and slightly overweight defensive, so we haven't adjusted it too much at this particular point in time. I think from an Australian equities perspective, the growth looks pretty muted. It's only sort of around a couple of percent into FY25. So, and it's really been the resources and energy sector which have seen earnings under pressure. So if we do see, that very strong enactment and fulfilment of that policy stimulus out of China, that could be quite positive to the resources sector and also the energy sector going forward. And that could sort of therefore, put a bit of a floor under the earnings and perhaps see, stronger earnings growth out of Australia, given we have seen quite a few, a fair bit of earnings downgrades over the last 3 to 4 months. I mean, earnings have been downgraded sort of 5 to 6% over the course of the last 3 to 4 months coming out of reporting season for FY25. So from an equities perspective, Aussie earnings are quite somber relative to international markets, but broadly from a tactical asset allocation perspective, it's really around valuations. We think that the market's probably a bit too complacent in terms of equity markets and the risks around that. And given the elevated valuations there, I think earnings need to at least surpass expectations in the market, and we just don't think the macro backdrop is supportive for that at this particular point in time.
Grant, of course, Aussie investors love their dividends. How are you viewing those returns at the moment?
Yeah, it's a good point. Contrary to some people's expectations that because the market's risen, then income should rise. Well, I mean, income, depending upon obviously on your investment strategy, may well be flat to down this financial year relative to the prior financial year. Obviously, we've seen an improving income profile from defensive assets, especially relative to a couple of years ago. But that might be peaking out as rates start to move lower. And if you look at Australian equities and the underlying dividends there, they've fallen for the last 2 years and are currently forecast to fall by around 1% in FY25. And it's really that resources sector which has led dividends down. And they're expected to fall again. And also bank dividends are expected to be pretty flat at this point in time. So it's interesting, if you look at the dividend yield for the Australian share market, it's now back to 3.5%, which is well below the long-term average is sort of around that 4.4%, and probably indicative of the fact that equities still appear a bit expensive in our view.
So as a result, can you give us a sort of a closer look, I guess, at your allocation there, some of those stocks you're preferring at the moment?
Well, within Australian equities, if we look at a couple of ideas and stocks that we've got exposure to there, I talked a little bit about resources and energy. The energy sector has been one which has been a real underperformer over the course of the last year, obviously on the back of sort of falling demand and increasing supply in all markets. However, we think the sector might be seeing a bit more interest given obviously we're seeing increasing tensions in the Middle East. We've got obviously threats to oil supply as Iran's been sort of caught up into the conflict now. And we could see, given the Iranian market is a big producer of oil, they're a large exporter of oil, and obviously the Straits of Hormuz could be at risk. That could see oil prices rally. We're seeing obviously central banks move to more of an easing cycle, which should support economic growth, especially around manufacturing and industrial production. And manufacturing has been obviously weaker than services. The China stimulus, if that is enacted and it's quite strong, that could boost demand. And we'd see the sector as offering attractive valuations and investor positioning as being underweight. And when we look at something like Santos, which is one of our preferred plays within the energy sector, we think the fundamentals there look quite attractive on a medium-term basis. The company's generating strong free cash flow. It's got a strong balance sheet, good management team. And they've got a real phase of project growth coming through at the moment. Those projects are on time and on budget. And as they're deployed, you're going to get this really strong production growth outlook over the course of the next 3 to 5 years. That's going to produce really strong cash flows, which are going to be used for shareholder returns, maintaining that strong balance sheet, investing in projects, and also investing in energy transition. And we're seeing that through things like the carbon capture storage projects. So overall, something like Santos, we see it's undervalued on a number of different metrics and also has an improving dividend profile.